If you're 65 or older, I want you to pay attention for a few minutes because a lot of retirees are about to make the same mistake this tax season, and it's the kind of mistake you don't notice until the refund is smaller than expected or the bill is larger than it had to be. A quiet change has entered the filing landscape for seniors, and whether it helps you or not comes down to one simple thing. Do you understand it early enough to plan around it, and do you claim it correctly when you file? Because if you miss it, nobody at the IRS is going to tap you on the shoulder and say, hey, we noticed you qualified for a bigger deduction. Want us to apply it? That's not how the system works. The IRS processes what you submit. That's it. If the deduction isn't on your return, you don't get it, even if you were eligible. Now, there's a lot of noise online, and when something new appears, the internet tends to exaggerate it in two directions at the same time. Some people will tell you it's life-changing for everyone. Others will tell you it's fake or doesn't apply to real people. The truth is usually in the middle. This change can be meaningful, especially for seniors living on Social Security plus modest retirement income. But it comes with rules, income thresholds, and a limited time window. That's why it matters to understand it now, not later. Here's the core idea in plain language. A newer senior-focused deduction has been introduced for taxpayers age 65 and older that can reduce taxable income beyond what many retirees are used to seeing. Think of it as an extra layer of protection for part of your income before federal income tax is calculated. For qualifying seniors, it can be thousands of dollars of additional income that never gets taxed federally. And because it's a deduction, not a credit, it reduces the income that gets exposed to tax brackets. That means it can lower what you owe or increase what you keep. But this is where people get tripped up. Most retirees already know about the standard deduction, and many know there's an extra amount added for being 65 or older. So they assume, that's my senior benefit. I've already got it. And under the old mental model, that was basically true. You took the standard deduction or you itemized, you got your age add-on, and you moved on. The problem is that when a new deduction is layered on top of a structure people have memorized for years, they don't instinctively go looking for it. They file the way they filed last year. They rely on last year's checklist. They don't realize the rules changed until the opportunity is already passed. What makes this new piece different is the stacking effect. It doesn't necessarily force you to choose between itemizing and taking the standard deduction. It doesn't require a special account, a special purchase, or a complicated strategy. It's primarily tied to age and income. If you qualify, it reduces taxable income. If you don't qualify, it doesn't. That simplicity is exactly why it's so easy to miss. People assume something that helpful must come with a complicated catch, so they don't believe it exists, or they assume it's automatic, and it's not automatic. Let me say that again in a way that sticks. You don't receive deductions because you deserve them. You receive deductions because your tax return claims them correctly. Now let's talk about the time element because this is where the urgency comes from. This deduction has been described as temporary, tied to a specific multi-year window. In other words, it's not something you can put off for someday because someday may arrive after the window closes. If the rule is available for only a limited set of tax years, then each year inside that window becomes more valuable. Missing 1 year doesn't just mean losing savings once. It can mean losing savings repeatedly because your future decisions often depend on how you handled the first year. If you don't understand it early, you can accidentally structure your income in a way that reduces or wipes out the deduction before you even file. Income thresholds matter here. This kind of senior deduction is commonly designed to benefit low and middle income seniors the most, and it often begins to phase out as income rises. That doesn't mean higher income seniors get punished. It means the deduction shrinks as income climbs past set levels. And that's where timing becomes practical planning, because many retirees have income they can control, at least a little. IRA withdrawals, 401k withdrawals, Roth conversions, capital gains timing, even part-time work hours. Those are choices. And when a deduction phases out, those choices can determine whether you keep the full deduction, part of it, or none of it. Here's a simple example of how planning becomes real money. Imagine a retiree who normally withdraws a certain amount from an IRA each year, but this year they were thinking about taking a much larger withdrawal for a home repair, a car purchase, or helping family. That larger withdrawal might push income into a range where the deduction starts shrinking. In that situation, spreading the withdrawal across 2 tax years could preserve more deduction across both years. That doesn't mean everyone should do that. It means you should at least be aware that the choice has consequences now that didn't exist in the same way before. And that leads into one of the most misunderstood parts of this entire topic, how it interacts with Social Security taxation. There's a claim floating around that a new senior deduction eliminates taxes on Social Security. That's the kind of statement that sounds good, spreads fast, and creates expensive confusion. In reality, Social Security taxation is determined by a formula that looks at combined income. If your combined income crosses certain thresholds, up to a portion of your benefits may be taxable. A deduction can lower your taxable income and reduce the final tax bill, but it doesn't magically rewrite the Social Security taxation formula. What it can do, for many retirees, is reduce the tax impact so much that it feels like Social Security became tax-free, because the amount that would have been taxed is wiped out by deductions. But the mechanism matters, because if you misunderstand it, you can misjudge how an extra $5,000 or $10,000 of income affects you. This is especially important for seniors with multiple income streams. Social Security plus a pension. Social Security plus IRA withdrawals. Social Security plus dividends and capital gains. Social Security plus part-time work. When income is layered, the tax system doesn't treat all dollars the same way. Some dollars trigger thresholds. Some dollars influence how much of Social Security becomes taxable. Some dollars affect whether deductions phase out. When a new senior deduction enters the picture, it's not just free money. It's a new variable in a system where variables interact. Now let's bring this down to the practical question every retiree asks. What do I have to do? First, you file using the correct current year forms. Most seniors use Form 1040 or the senior-friendly 1040 SR. The senior form is usually easier to read and track, but either can work. The important part is that the return is prepared with updated rules for the correct tax year. Filing with outdated software, using old worksheets, or copying last year's approach without updating can cause the deduction to be missed or calculated incorrectly. Second, the age qualification must be correctly indicated. That sounds obvious, but you'd be surprised how many returns are prepared by someone else, rushed through, and the age-based sections are not properly handled, especially if a spouse recently turned 65, if a spouse passed away and filing status changed, or if a preparer relies on old templates. Small errors cause big outcomes. Third, you need to understand whether you're in an income range where the deduction is reduced. This doesn't require a finance degree. It requires awareness. If you're well below the threshold, great. Your focus is claiming it correctly. If you're near the threshold, your focus is how to avoid accidentally pushing yourself past it with one avoidable move. And if you're above the range where it disappears, your focus may shift to other strategies that matter more for your situation. Now, for married couples, this can be even more valuable, because retirement planning is often a team sport. If both spouses qualify by age, and the rule allows the deduction for each qualifying spouse, the combined reduction in taxable income can be much larger than a single filer's. That matters because many couples live on a careful balance. One Social Security check, the other spouse's Social Security, maybe a pension, and controlled withdrawals from savings. A larger deduction can be the difference between staying in a lower tax bracket and creeping into a higher one. It can also reduce the chance of unexpected underpayment issues. Another detail retirees should not ignore is withholding. Many seniors don't have taxes withheld from Social Security by default, and they may take retirement withdrawals without proper withholding. When your tax situation changes, your withholding plan should be reviewed. A new deduction may lower your tax bill, which is good, but if you're guessing instead of calculating, you can still end up surprised. The goal is not just pay less. The goal is pay what you owe and not more than you owe without panic in April. Now I want to address something that's just as important as the deduction itself, the scam environment that grows around new rules. Whenever a new senior tax benefit becomes widely discussed, scammers immediately start using the same keywords: urgent, claim now, special enrollment, refund boost, government-approved program, call this number, verify your information. If someone tells you that you must sign up, pay a fee, or provide personal information to activate a deduction, that is a major red flag. A legitimate deduction is claimed on your tax return. Period. There is no enrollment process. There is no secret application. There is no special IRS registration. The only real action is filing correctly. So the safest approach is boring, and boring is good. Use current year forms. Use reputable, updated tax software or a trusted professional. Keep your documents. Review your return before submitting it. And if you work with a preparer, ask directly whether they have accounted for the new senior deduction rules for the current year. Not because your preparer is incompetent, but because tax law changes are exactly where even good professionals can miss a line item if they're overloaded or relying on old checklists. And here's the final point that makes this worth your attention right now. Because the deduction is tied to a limited window, the next few years become a planning opportunity, not just a filing chore. If you're approaching required minimum distributions, if you're considering Roth conversions, if you're thinking about selling investments, or if you're planning a large withdrawal for a major expense, the question isn't just, can I do it? The question becomes, when should I do it to keep more of what's mine? A temporary deduction changes the calendar value of income. Income taken during the window may be taxed differently than income taken after it. In some cases, pulling forward certain taxable income into a year where you can offset it with a larger deduction could make sense. In other cases, delaying income until after a high deduction year could make sense. The right answer depends on your numbers, but the principle is the same. Timing is no longer neutral. So don't treat this like a random headline. Treat it like a tool that can reduce your taxable income, lower your bill, and help you keep more of your retirement money for what it's actually meant for, your life. If you are 65 or older, the smart move is to do 3 things. Confirm your filing with updated rules for the correct tax year. Confirm your age qualification is properly reflected on the return. And look at your income level with clear eyes so you understand whether you're getting the full deduction or a phased out portion. Even if you only qualify for part of it, partial savings are still savings. And if you qualify for the full amount, missing it is the kind of mistake that hurts because it was avoidable. The clock element is real with temporary rules. Once a tax year passes, you don't get unlimited chances to redo it, and you don't get rewarded for meaning to claim it. You get rewarded for claiming it correctly. This is one of those moments where a small amount of understanding protects a large amount of money, and the retirees who benefit the most won't be the ones with the fanciest strategies. They'll be the ones who simply knew what changed, claimed it correctly, and planned their withdrawals with the new rules in mind.